What's up, Resource Nation? Back-to-back interesting interviews today. With me again, probably for the fourth or fifth time, reoccurring guest, Garth Graham, all the way from Florida. Buddy, thanks again for carving out time with us.
I do not remember you saying it had to be interesting. You
It
just
doesn't.
said you were going to do an interview. I didn't, that's a heck of a standard. I have to actually be an interesting interview. So
Hey, well,
I'll do my best.
let's take a left right out of the gate. In the green room, you just told me what you did with your time, and I think it's really cool. Can you share with the audience, during COVID, you pivoted from Stratmor a little bit? Well, you're probably still working, but the little guy over your left shoulder, you did something with him and some others. Tell us about it.
Yeah. So basically, I travel typically 40 weeks a year. I'm a dog lover. We lost our dog about 4 years ago. We've always had dogs, or a dog. And so as soon as COVID hit, I said, hey, I'm going to foster dogs. So I wasn't committed at that time that I was going to get another dog. So I've had 5 fosters. And, foster dogs, you bring them in from the rescue, which, by the way, the rescues all had to close down. So there was a need because of COVID for people who could say, I'll take a dog sight unseen. I'll help them go to the vet appointments, that type of thing. So I did 5 foster dogs, of which that one is what we call a foster fail, which meant I failed to put him up for adoption.
Right.
And kept him. So
what's his name?
His name is Alfie. Although, to be blunt, I don't know what his name is, but I call him Alfie because he was
It could be anything, but we call him Alfie.
He was a 10-year-old stray. As people say, it's like, does he know his name? I'm like, I'm pretty sure he does. I just don't know his name. So
that's awesome. What a great use of COVID time. We skipped your intro, but I think it's because people know you. It's Garth Graham, Stratmor. His bio's on screen right now. But let me just tell you this: there's a really good chance that your CEO or your C-suite has spent time with Garth, or either leveraged his time or been consulted by Garth and Stratmor. So I love having him on. Super high level perspective. Back in 2018, we were talking quite a bit, which is kind of my first question, because it was a different time then. We've just went through 2 years of prosperity in the mortgage and real estate business. So
that's for sure.
I guess let's get into that, because I got this weird feeling. Think back a million years ago to 2018, Garth, with me, okay?
Yeah.
I'm not going to say close your eyes, but think back a million years ago to 2018, and we had phrases like margin compression, and we talked about LO comp, and cost to originate, and lenders losing $200 a loan versus making money, mergers and acquisitions. So why? Call me crazy, set me straight, man. We just came off of 2019. We just came off of 2020. Q1 of 2021 was amazing as well.
Very good year. Yep.
What is wrong with me? Why do I have this weird feeling like 2018 vibes are coming our way? Am I just crazy, or maybe I'm onto something? I don't know.
No, I think you're not crazy. And actually, I can give you a couple other historical footnotes. But really what happened in 2020 is interest rates dropped 2% from 2018. And what that did is caused a big spike in refinances. So in 2018, we were about a $1.6 trillion market. In 2020, we were a $3.7 trillion market, more than double. But most of that double, we saw an increase in purchase, but most of that doubling was a dramatic increase in refinances. It was more than 50% of the volume. And we should all know, those of us who have been in the industry for a while, is a refinance is a temporary, it's a temporary hit in a good way. But it isn't really a sustainable. At some point, rates are going to go back down. And I want to give you one other historical point. The last time from 2020, the last time we had a market that big was 2003, when interest rates plunged over a 2-year period from 8.2% to 6.2%. So, 6.2, we're in the 2s right now. So that's how crazy things have been. But what happened coming out of 2003 is rates started going up. And if you've been in the business a while, the way the market handled the drop in the easy refi is they started going down the credit spectrum. And that's what ultimately led to 2006 and the bust, really around 2008. That's not going to happen again. I mean, we are not going to see a dramatic flight to, subprime all day, no doc type loans. That is not going to happen.
Learned our lesson.
Climate, nor the risk parameters aren't there for that. So what we're instead going to get is a hard landing of a dramatic shedding of the refinances, and likely to see a pretty big drop in the market over the next 12 months. It will not be as bad as 2018 in terms of total numbers. However, it's going to be coming off of a high from 2020. So the change impact will be severe. The overall market size, though, it's still going to be, projected to be a pretty good market, 2.2 trillion, probably over the next 12 months.
Majority of purchase business, though, which will be the big shift, yeah.
And the big shift is it's going to be a 25% refi and a 75% purchase, and the people who are able to generate purchases are going to be the ones that are, going to be better off.
So why do I have this weird feeling, and back to 2018, like we were right. like probably at the top of the mountain in terms of like profitability, and everybody set records and volume. I don't know nothing about nothing, so this isn't like a weird like statement, but I'm guessing even though lenders made a lot of money last year, that M&A activity and conversations has picked up. Again, I don't know nothing about nothing.
Right.
Is that accurate?
Yes. So the very interesting part is the M&A market for mortgage banking. Generally, when the market is doing poorly, there's more deals. So there were twice as many deals in 2018 as there were in 2019. The difference really in 2020 is the fact that it was such record profits. There were some sellers that, despite making a lot of money, were willing to enter the market because at least some of them had promised themselves, if I ever have a boom year, or if I ever have reach a personal net worth of blank, whatever the blank is, I'll consider selling and take my chips off the table.
Right.
So I think that, 2020 was a pretty good market. 2021 will be a lot of M&A. There'll be some consolidation for sure. We're already extremely busy with M&A activity.
So for the common man watching, the consumer, maybe even realtors, what he's saying, and I'll try to use an analogy, is you had a good run on the craps table, and you're like, I think I'm going to take my chips off the table, even though maybe there's another small run, but they're taking their chips off the table. They had a good run. A question that we didn't prep for, but I know you'll know it, so it'll be easy for you. And this is me getting in the weeds, so forgive me. We don't get high-level people like Garth every day that understand this at a very deep level. If I'm going to be the company acquiring a company that just had a great run like you're talking about, how do I price that in knowing that they just had their best year, and I'm buying this company or merging with this company that we talked about volume shrinking, and I'm guessing margins will shrink with that too. So what's the basic level of looking at how I price that into acquiring a company that is coming off their best years ever and probably going to slow down a little bit?
Yeah, well, it's an art form, not a science, that's for sure. But certainly part of the pricing of that is looking into the numbers deeply and saying, how much purchase business are these originators doing? Have they feasted solely on refi, or are they just doing the refis in addition to a robust or a healthy purchase? So they're forecasting a different number, based on, it's not going to be 2020's number. They just have to be good at forecasting what am I really going to get out of this.
Gotcha.
The other element, though, with the bigger companies, a lot of the big companies who are buying, they can add another $1 billion, $2 billion, $3 billion in production if they're buying a company without probably adding any corporate staff. So for them, it is highly accretive. The numbers work better for the buyer than they would if the seller stayed on their own.
Yep.
In M&A parlance, that's referred to as synergies. So I think those are probably, two of the things that factor into it. But ultimately, a key part of it is that the buyer needs to be able to deliver certain capabilities to the seller's sales force. They're really the most important part. A lot of the value is embedded in the individual relationships that an individual loan officer has and the licensed ability to originate loans in a compliant way. That's the value. So they are certainly going to have to deliver, good marketing, good turn times, good products, pricing, et cetera, in order to retain that staff. And that's what they're typically got to build in the model.
That's, things the average loan officer or realtor doesn't think about. But interesting point, like just because a merger or acquisition has commenced doesn't mean the hard work is over. Like it actually has started. And you're saying you almost have to start recruiting and retaining the people to add value to show why this happened and why you're better off with this new company. Yes, super interesting. Right. We had Logan from Housing Wire, and I was talking actually with Logan last night and David Stevens, who in a clubhouse room.
So they're interesting. So that's my standard. Good Lord, Dave Stevenson and Logan. Okay,
that was last night's clubhouse room. So
right,
they were unpacking a lot of what they believe is going to happen in 2021. And Logan was on our show, and he outlined beautifully why he felt real estate is going to be really strong, at least for the next 3 to 4 years. I agree with him. He does a lot of homework. If you know Logan, he supports his homework with graphs, charts, all the good stuff. But I'm curious your thoughts. Do you agree with the real estate statement being strong? But also, I think you probably will. It's not hard to see that housing is going to remain strong. But I feel like lending will face headwinds moving forward, and maybe that's higher rates, continued mergers, acquisitions, fierce competition. I feel like, the pie is shrinking, so we're all fighting over a smaller piece of pie. That probably affects margins, back to my 2018 conversation.
Yep.
Right-sizing operations and tech stacks, which will be another question after this one because you wrote a really good article. But, how do you feel about that? Real estate being strong, and then also, what headwinds lenders are going to face moving forward?
So here's one thing. I always tell people when you look at the market size, and I just actually gave you a bunch of statistics related to the market size in a term of dollars, right? 1.6 trillion to 3.6 trillion. Last time it was 3.6 trillion. It was 2003. It's actually even more interesting to look at units. And the reason is because the units represent a human being trying to accomplish a certain goal.
Yeah.
So here's an interesting stat. Over the last 10 years, we have never had a year, where refinances did not go up or down by at least 20%.
Wow.
Last year, it went up 100% in units. The year before that, it went up 80% in units. That's a staggering number. That's where all that capacity, because you gotta manage the unit. You don't close the dollars, you close the unit. You close the Jones family loan.
Right.
Purchase, if you look at it over the last 10 years, has never had a year that's gone up by 10% in units.
The old steady Eddie.
Steady Eddie.
Yep.
Now, and the reason I say it's important to look at it that way is you don't see it when you look at dollars, because price appreciation makes the market appear bigger. And I know realtors and loan officers and mortgage bankers, our income is tied more, frankly, to the dollar. But our efforts should be focused on the families and the units. And that's actually where the pain point comes from. That's the capacity problems. So it will not likely adjust up or down by 10%. So while Logan is confident, it's still a confidence level within a pretty small range.
Right.
Plus or minus 10% in traditional, growth markets, you'd say, oh my God, a 10% growth rate is like huge. But, it's the refi where you get the craziness. I do also agree that the purchase market will be good. There's certainly pockets of real estate where inventory is challenging. You'll, as a lender, instead of taking easy refis, you're going to have to do a lot of pre-approvals, and you're going to have to update the pre-approval, and you'll have to continue to work with the pre-approved customer for the 6 to 9 months that it may take for that person to finally find the right home that they want to put a market on. And our real estate partners are the ones that are kind of shepherding these people through that process. So it is painful, and you're going to have to carry a big pipeline of prospects in order to get the pull through, whether you're a real estate or a loan officer. Prepare for a big pipeline.
Yeah, it's funny, you talked about how refis at least move 20% a year.
Yeah.
Because I'm a mortgage nerd, I've already crunched that number. It's 39% drop in projected refinance drop from 2020 to 2021.
That's right.
So a huge swing. From memory, I think it goes from 1.5 to 1.6 trillion in purchase business. I hope that's right. We can pull it up on the screen. But that's what I mean to kind of tie both of our comments together about the pie shrinking. It's going to shrink. I think you're 100% right that the incubation period with each individual family is going to be longer. Guess what happens when that happens is they have more time to maybe find another person, i.e. another loan officer, to talk to, and bounce ideas and programs and rates, i.e. shopping comes into play, i.e. buyer fatigue also comes into play. Like, man, I've made 30 offers. It's been 6 months. I might just stay where I'm at. So I think that is super smart about what you said. Like, that's going to happen. Now, what we need to do with your words is kind of prep our businesses and our strategies and our even technology for that. There's lots of technology that can help incubate that process versus just talking to your LO or realtor once a month once you finally get a home that you're interested in, and unfortunately probably get outbid right now.
No, that's right.
So technology comes into play, and you wrote a really interesting article about technology that we'll pull up and we'll put in the comment section below
Sure.
It's a really good read. Again, lots of supporting charts, graphs, and graphs in there. But give us, and you guys really need to unpack this because it's really good. I actually sent it to a few CTO friends of mine because I think it's that interesting. But give us like the distilled version of that, maybe 10,000 foot level, just to kind of tease it so they'll go in and read it for themselves.
Yeah, no problem. So we do actually a lot of survey around the mortgage industry. And the mortgage industry, what we do is we have sort of what we refer to as a digital roadmap. It's about 41 critical functions that go into kind of the more digital experience. Do not hear digital meaning consumer direct or self-serve. It just means the ability for the borrower to communicate the way and execute the transaction the way they want to, still may be with a local loan officer right at their side. So a lot of this is retail. But the digital mortgage adoption has gone up substantially if measured by what the lenders have implemented, meaning that lenders have implemented twice as much of the feature set that we identified through 2020 as they had in 2018, to go back to our bad year. So we are ramping up more ability to apply online through a nice wizard process, upload your documents, secure an online approval, get your status on your mobile phone. All these types of features are available. The gap here for an industry, though, is that the adoption at the user level is roughly half of that. So we're getting a lot of shiny tools and we're adding a lot of capabilities, but we're only using it about half the time. And that user adoption is two things. It is the consumer to some extent, and it's the people in the industry, loan officers, processors, et cetera. But a big part of it is the loan officers' willingness to leverage the technology as well. So an example, and I'm going to use this one because of the real estate friends. If you have a borrower who's in a pre-approval, and it's likely to be a 6-month nurture because it's going to be a long time for him to find his pre-approval. You need a CRM so that you can continue to reach up. You need a text thing so he can go back and forth. You need a way to share information quickly with the realtor so you both know the status as the borrower begins to engage quickly. If he starts going online and shopping and whatnot, you need some level to get some notification so you know that. All of these things in that long nurture through technology can have a big impact, but not if you don't use it. Like if you have one phone call with the borrower and say, okay, well, if you find a home, give me a call. And then, you put it on your scratch pad and hope you remember to call him. Dude, that's not going to get it done. Right. So really the gist of the article is we're about halfway there in the digital tools that we as lenders have implemented, but we're only about halfway using them. That's really the punchline.
It was funny, in the same clubhouse room with Stevens and Logan and Clayton Collins from Housing Wire, they were talking about going to a technology conference when those were a thing, in 18, and the conversation, because that was really the start of the battle. Well, not the start. I mean, you've been doing digital mortgages. I think you had the first one ever type thing, but the industry's so slow. In 18, there was really this like push for adoption from a corporate level and organizational level, and even then they were arguing over font size and making sure like the font size could work in like a DocuSign. I'm like, good Lord, that's the conversation. It's got to be deeper than that. And that's just, mortgage is a little bit slow, big ship to move, and we're finally getting there. But to your point, we're only halfway there. And I loved your analogy in the article, and this applies to realtors too, because real estate offices have technology that isn't leveraged as much as it should. And you said, and this is memory, you can correct me if I'm wrong, but it's like having a fast pass from TSA and you going, you know what, I don't want to use and leverage this fast pass. Let me just take off my shoes and my belt, get my socks dirty, go through the old security line. Let me just take the long route here. But that's exactly how technology is. Like, you guys have it in front of you to make your lives better, to be more relevant, to Garth's point, to the consumer, to offer a better overall experience. And realtors and loan officers are like, I don't know.
Right. So half the time, I think they are. They'll go back to their old habits. The one I will say is this is my other analogy, and I don't think it's as clever as the take your shoes off one. So that's why that made the article. But it's really a three-legged stool to implement any sort of meaningful change. And digital mortgage is people, processing, and technology. And the people, the loan officers, need to make some changes. They need to educate themselves on the way the tools are, and they need to reinforce the value to the individual user, like the customer. So saying, hey, I'm going to send you a link, go ahead and apply, is not nearly as effective as saying, I have an amazing online application.
Yes.
You're going to have an amazing experience if you do it. It is going to ask you to share some additional information. It only takes a minute, but the entire process works better. And I'm going to call you tomorrow to see how it went for you. Can you do it tonight? Now, that's a totally different
Good Lord, that's an
people communication.
Can I hire
right?
you as a loan officer, Garth? That was amazing.
I was a loan officer, so 20-some years ago. So, and meanwhile, I just described then the process is different, right? So I'm now going to call him. I'm going to reinforce it. If he doesn't fill out and opt in to share assets, as an example, I'm going to have myself or my assistant, my processor, they're going to now reinforce the value. I'm changing my process. Meanwhile, I do have the technology. It's the people, process, and technology. If you don't do all three, you're going to get a 50% adoption.
Well, it's all in the presentation. I love the way you presented that. Like, we can just snippet that, and I'm sure mortgage companies can just use that for training. But, if you've done a loan for a family, which most loan officers have, right? Recurring clients coming back, like, hey, remember when I had to grab all those bank statements and I would bug you for the last page and it would be blank and you go back and forth and it'd take a week? Well, you know what? Now we actually have an application interface that goes right to your bank. You just got to give it the thumbs up to share information with us, and I will never have that conversation with you again. Like, that's a great setup to, this is going to make your life easier. It's going to be an amazing experience. Because I know...
You know what? You should be the loan officer. That was fantastic.
Well, if you don't, they're going to be like, what's this thing that I have to give my password to? And then, they start creating a narrative in their head that, we're going to have access to their key bank account. Like, no. So again, it's back to the presentation. And I promise you, we have found, we use Blend, and we have found, and we can just say any digital POS or LOS.
Right.
Our applications are significantly, and you probably have the data, being Stratmor and Garth, significantly more complete leveraging the technology versus the old school. Garth, what's your first name? Okay. Yeah. What's your last name? Okay. What's your birthday? Like, oh, you don't know how much you make? I'll come back to you on that. And then you just take this half-ass application. And we have found, and trust me, I've had to push even young LOs into this, and then they come back to me like, Hills, you're right. I'm like, yeah, I know.
Right. Well, the other is it's not replacing the human, the loan officer.
Right.
Suddenly, the loan officer's conversations are valuable. So how did you like that digital application? Wasn't that easy? Isn't that great? By the way, do you know anybody else who I may be able to help? And I've already submitted it to my team. I did notice one thing, Kate, how often do you get your pay stubs? Oh, every couple of weeks. So when are you going to get the next one? Because I think you uploaded one. Oh, you'll get it next Friday. So you can upload it then, right? Terrific. So that link, you set up a password. You remember it, right? Okay, so next Friday you can upload the pay stub for me. Yep. Terrific.
It helps you be in a more consultative role than the first typical conversation in the past has just been an order taker.
Yeah.
And I know that's just part of the process. So I'm not calling you an order taker, but that process is an order taking process. Now your first conversation, to your point, is more of a meaningful consultative conversation because I have all this information now. Right. I have bank statements. I have, if you've had a bankruptcy, if you've moved jobs, I can really come back to you and provide value right out of the gate because I have all this information. So now we've accelerated the process and we're adding more value to the consumer with a yes is a yes. And it's not just, well, this looks kind of good. Yeah, here's a pre-approval. Your yeses are yeses, your nos are nos. So we didn't plan to kind of go there, but organically that just happened, and I'm glad that we did.
Awesome.
One last question as we wrap up,
Sure.
man. I know your time's valuable, but in the context of everything we talked about, what's coming, what's happened, you have such a unique perspective. Like, you just get to see into all these amazing companies and what makes them work, what they struggle with. What do you see if you aggregated all that data down, as far as like what lenders should be working on right now that maybe aren't yet? Like, you know what I mean?
So if I'm talking to a CEO, and this was in 2020. I would really challenge them, just as you did when you first started this conversation by thinking about 2018. I would challenge them to have a plan for when the refinance volume drops by 40% or more, and what are you going to do about purchase, and how are you going to handle the staff. You have a plan, have it, that plan be very specific. Know the value of all your key employees, so you know exactly the ones that you really want to reach out and touch as the market gets tougher. Have a plan. I'd say the exact same thing to a loan officer. So have a plan.
Yeah.
How many relationships do you currently have? Where do you have a gap in your own personal business? Well, none of us are perfect. So what's your gap, and how are you going to fill it? And what are you going to do to make yourself a better professional? There's probably some training. There's probably mentoring. There might be, maybe you need to invest more in marketing. So you ought to be looking at marketing tools.
New revenue streams.
Maybe you're not 100% using your CRM and your digital point of sale. So what are you going to do to become that? So have a plan for how you're going to ride it, because we are not going to be a rising tide lifting all boats in the remainder of 2021 and into 2022. And it's going to be a tougher market for sure. And it's going to be a tougher market for all the counterparties, realtors, et cetera. It's going to be a good market, but, develop those relationships, keep the lines of communication open, be sure your team is brought along as the market changes and they understand, the impact on them as well. And by the way, we went through an entire meeting, and other than talking about my dog, we haven't talked about the fact we're going to come out of COVID at some point, and the disruption that was everybody go work from home is then going to be partially reversed.
Mm-hmm.
But what does that mean, right? So are we going to go back into offices, or do we not need as many offices? So the CEOs are certainly thinking about it, but so too are, should an individual loan officer. What does it mean now when I don't have to go into an office all the time and make copies?
Or,
how could I do my business differently?
Usually there's 100 realtors in an office, that they're not necessarily there anymore. So how are you going to meet them? Where are you going to meet them?
100%.
I've learned that knowing the right thing isn't typically the hard thing. It's doing it. And what you're saying applies to both organizations and individual loan officers and realtors, which is, look, you can wait for the market to dictate this to you, which nobody wants to wait till Q2, 3, or 4 when the market says, hey, Mr. Executive, you got to right size. You got to get flat. And now you're being reactive, and the same applies to LOs. Hey, LO, hey, a realtor, you need to tweak, adjust your plan, because it's not 2020 anymore. Refis aren't raining down from the heavens. It's going to be a little bit more difficult. So you can either wait till the market dictates, or you can be smart and do it now and be ahead of the game and be flat and right-sized and tweak your business plan before this happens. And guess what? When the market dictates, everybody else's hair will be on fire, will be running around, and you'll be stealing market share.
That's right. I think that's going to be key. You're going to have to grow into a down market, which means you are going to have to take market share in order to continue to succeed.
Yep.
That's whether you're the CEO or the loan officer, and each of you need to understand what your market is and how are you going to go get it.
Yep. Man, it's good to see you. I'm not just saying that because you spent time with us today, but you actually look younger, man, from the last time I met you. Like, most people came out of COVID the opposite. You look better, man. You're looking good.
Well, I appreciate that. And I did, by the way, stop eating meat.
Oh.
And so my other COVID event is that my adult daughter, age 25, 1 year ago, came back home. She works from home, but, moved back from LA. She's in finance, so we have, dueling finance jobs going on back here. But she's a vegan and started cooking. And little by little, after a few months, I said, I don't feel like cooking steak for one. So, it's my wife and daughter weren't eating it, so I ditched the dairy and I ditched the meat. So I still eat
it's
fish.
Working, man. I'm not just saying that. You do look younger, healthier, like happier. Like, good for you, man.
Yeah. And I will say one thing to the audience. I hope it was interesting and that you guys paid attention and got more out of it than Alfie.
You might want to nudge him. Like, he's sleeping hard over there.
Yeah, yes, he just sleeps. He's used to this. You ask Alfie how he spent COVID, and he said sleeping in a bed, listening to that guy talk.
Listen to Dad talk to executives about how to run their business.
Exactly.
All right, buddy. It's good to see you. REsource Nation.
Awesome.
Make sure you follow Garth on all social streams. Go to stratmor.com. We'll put that link below and the link to the article below. You definitely need to read it and share it up with your C-suite. Amazing, interesting interview, not on my part, but on your part, and a lot of gold there for us moving forward. So thanks again, buddy.
Terrific. All right. I appreciate it, Ryan.
All right. See you guys next week.